And that's when he realized his TFSA was a trap. Imagine thinking you're doing everything right by saving in a tax-free account, only to find out later that your money isn't growing the way you expected, and you're missing out on huge investment gains. What if I told you that understanding investing basics could save you thousands or even tens of thousands of dollars over your lifetime? Whether you're just starting your financial journey or have been hesitant to invest, this guide will unravel the fundamental concepts you need to know to get started confidently and avoid costly mistakes. This isn't about complex jargon or risky tips. It's about clarity, strategy, and building wealth step by step. Investing can seem overwhelming at first. The endless options, the confusing terms, and the fear of losing money often stop beginners before they even begin. But knowing how to invest wisely is crucial in today's world where inflation constantly chips away at your cash's value. Did you know that according to a 2023 survey, over 50% of Americans don't invest because they feel they lack adequate knowledge? That's a massive opportunity missed. Investing isn't a mysterious game reserved for Wall Street insiders. It's a tool that anyone with discipline and patience can use to grow their money over time. For beginners, understanding the why and how behind investing is the foundation for building financial security. Consider the case of Sarah, a 28-year-old newcomer to investing. She once believed saving money in her piggy bank was enough. But after learning about the power of compound interest and investing in diversified funds, she grew her savings from zero to a six-figure nest egg within a decade. Stories like Sarah's remind us that starting early, no matter how small the amount, makes a massive difference. On the flip side, rushing into investments without understanding risk can lead to frustration or losses. The key is to start with a solid foundation. Know your goals, understand risk, diversify your assets, and choose the right investment vehicles. By grounding yourself in the basics, you avoid common pitfalls and set yourself up for success no matter your financial situation. Let's dive deeper into the very first principle, understanding risk and return. Investing is inherently about balancing these two factors. The higher the potential reward, the greater the risk involved. For example, stocks historically have offered higher returns than bonds or savings accounts but come with more volatility. Picture the stock market's roller coaster rides. There are exhilarating highs but also stomach-churning drops. The critical question is, how much risk are you comfortable taking? Knowing your risk tolerance depends on your financial goals, timeline, and personality. Someone investing for retirement 30 years away can afford more risk because there's time to recover from downturns. Conversely, if you plan to buy a home in 5 years, safer investments might be better. Take the anecdote of James, a 45-year-old who put all his money into a trendy tech stock just before a market crash. By contrast, his colleague Emma diversified her portfolio across different sectors and bonds. When the downturn happened, Emma's investments dropped but bounced back quickly, while James suffered significant losses that took years to recover. This example highlights the often overlooked but vital strategy, diversification. Spreading your money across different asset classes, stocks, bonds, real estate, and even cash equivalents, reduces risk and smooths returns over time. As the saying goes, don't put all your eggs in one basket. Modern portfolio theory supports this approach, showing diversified portfolios outperform higher-risk concentrated bets in the long run. Moreover, understanding compounding can change your whole perspective about investing. It's one of the few financial concepts that literally means making money on your money, and then on that money again. Albert Einstein reportedly called compound interest the eighth wonder of the world. To illustrate, if you invest $1,000 at a 7% annual return, after 30 years, it grows to over $7,600 without adding more money. Imagine making regular contributions and letting those gains reinvest. The total can balloon exponentially. But many beginners miss this because they focus on short-term market swings instead of long-term growth. Patience and consistency are your